Hello, everybody. We are joined by Trevor Greenway today, all the way from London, Ontario. And Trevor heads Inter-Val AI, and happy to have him join us on the podcast today. I'll let him introduce himself and tell us a little bit about what they do. You're already familiar with me. Let's go ahead, Trevor. Tell us about you and your company.
Wonderful. Thanks so much for having me. Excited for the conversation today. My name is Trevor Greenway. I am the co-founder and CEO of Inter-Val. Inter-Val is a startup that began in Canada just over 4 years ago. It has now grown across North America. We've been lucky to have a pretty exciting kind of growth journey. Basically, we're a software that it kind of sits between what we kind of call business planning and financial planning. So our belief is that we can help financial services providers, and financial services I kind of lump into three categories: kind of your wealth advisors, your accountants, and your banks. They all look to service kind of small business owners, but a little bit differently. And our job is to help them identify who are the customers that they can help the most, who are the healthiest, who are the most at risk, so that they can really do more of their job in a more proactive way as opposed to a reactive way. And the long tail benefit is that we get to help business owners. We don't sell to business owners, we sell to the institutions that help them. They're our payer. They actually give our platform away to business owners for free. They want their business owners to be constantly aware of the underlying health and value of their business so they make healthier business decisions and create better financial situations for themselves long term. They have a vested interest in that. Their financial services providers do. They want to help them in that journey. They want to help them place product, mitigate risk, manage cash. And so we're that intersection between how business owners run their business and they focus on that, but then ultimately making sure that their advisors are able to be there every step of the way to help them maximize that eventual outcome.
No, very nicely put. But before that, thank you for making time and appreciate having you on here. So, we cover a lot of good breadth of industry services, especially SaaS on these podcasts. So this is definitely an encouraging area for some of us that, or some of the listeners actually that are looking into the small business space and starting their journey. So it definitely helps. Given the background that you just provided us, I'm assuming you guys do this on both sides of the border, right?
We do, yeah.
Okay, perfect. So if just right off the bat, if there was an entrepreneur or aspiring entrepreneur that wanted to go out and set up their own SMB enterprise, how would they engage or, enroll into your services, or do they have to work through a financial institution?
They have to work through a financial institution,
Got it.
or again a wealth advisor or their accountant. So many of their accountants that they might work with, just even in their accountants that might produce their year end, many of them are actually already our customers. So as part of their year end, this is something that they get as well.
Okay.
Is access to underlying health and key metric analysis. They get benchmarked against their peers. So basically, turning what is a compliance exercise like a
Sure.
year end
Yeah.
and turning it into really an advisory exercise between them and their accountant. That's typically how they get it. We are not direct to consumer. It doesn't mean we won't be one day, but we're very much a B2B platform. Ironically, it's kind of B2B2C in that, the
Sure,
B that we
sure.
sell it to ends
Yep.
up giving it to the C. But that's ultimately, we're at that intersection where we believe we can create value for both of them. And
Yeah.
it turns out we were right.
Okay. Well, that's nice. If, say, for example, if their providers or their financial institution did not have this link, do you have anywhere where they can go to find that channel to reach you?
So typically what happens is we do get a lot of inbounds from business owners. And, a lot of times what we'll do is we'll link them up with geographically, okay, these are some of the customers in your area that are current, that are our subscribers
Okay.
to our platform. So we kind of act as that intermediary. Ironically, actually, business owners end up being a great lead source for us because oftentimes they'll go to their accountant or their bank or their wealth advisor and say, "Hey, why aren't you getting?" In which case, they end up reaching out to us and saying, "What? Tell me more about this." Right? So it ends up actually, creating a bit of a flywheel and a referral source or lead source for us as well.
Gotcha. No, that's great. Thank you for that additional background. Just wanted to set the frame after our intro here. So, we've already covered your company background, but our next few sections we'll dive into, what are current trends in your industry, what your current challenges are, any goals for the near term and the long term. And then, we'll wrap up with exploring any next steps just for the context of our listeners. So Trevor, we good to move on to the next section?
Let's roll.
All right. Excuse me. So as the CEO and co-founder, tell us about, your role beyond the title.
It's funny in that, CEOs for early stage companies is kind of a bit of a catch-all. I think the co-founder is probably more indicative of where you end up being involved in. And I've even noticed that, over the course of the last few years, even my role as co-founder or as CEO has shifted, and it tends, you kind of do what's necessary in the moment, where early on you're very product focused. We've got a head of product, but early on he was, a great up and coming product manager, and we collaborated on, the vision of the product, where we were going, talking to customers. So that was kind of at its core. And so that was a big part of my role. And then very quickly you get into, you put on the other hat for the CEO, and you're in fundraising mode and you're growing, and then you're involved in early stage kind of revenue conversations. And so for me, it's, the role ends up being very kind of erratic, in the sense that you do what's necessary in the moment. And I would consider myself very involved in account management and customer success. We're looking to build and grow and learn from our customers, product as well, sales as well, fundraising, board management. The problems just get different and bigger as the company grows. And you end up, sometimes longing for the days where you were involved in product, because you end up
Yep.
involved in a number of other things that are necessary evils, but
Right.
maybe aren't quite as fun. So you try and strike that balance and scratch the itch whenever you can.
You talked a little bit about fundraising. Are you guys self-funded, or do you have investment partners? What's the model today?
So we have no institutional investors. We've never raised any VC or growth equity or anything like that. We do have some early stage investors, private high net worth individuals that just kind of bet on us and bet on the market. But they were great supporters of us. They helped us get to this point. It's not that we're anti-institutional investors. We're actually growing pretty rapidly right now, and we'll likely do a large round later in 2026. And it'll be our first kind of true institutional round. And it was more so my belief that the foundation upon which you layer money,
Hmm.
like money has like proverbial weight, in that I think a lot of early stage companies, and the reason that failure rates are so high, is that they just assume, well, I've got an idea and I've got a little bit of traction, therefore I'm going to go raise, a pile of money. And, in certain markets, like, you get money thrown at you, but money has weight, and the foundation upon which you lay it, might, if it's not solid, all the money does is show the cracks faster. Right. And so we very much focused on, are our customers voting with with their wallet? Are we actually solving a meaningful problem? Are the leading indicators of future success there? And if you can prove that in a cash flow, efficient way, or a capital efficient way, then really you've built a foundation that won't break with the weight of money. And so that's kind of how we've built very systematically, at various times. Like, we wanted to prove we could get to cash flow positive, and we did. And so, it was like, okay, like, we built, obviously while you're building, you're in a burn. But then it was like, okay, are there customers paying you? And could you obviously grow faster? Yes. But if your money doesn't solve all the problems, like, do you have a solid go to market? Are you pretty confident you have product market fit? Do you have a feedback loop that is telling you that you're on the right track? When all of those lights start turning green, then you can be confident that maybe the institutional capital is now jet fueled to help you get there faster, and not simply a band-aid to hide bigger problems.
Absolutely. No, that's very true. And also, there is always a vision alignment that's needed, right? When you have people with the weight of money stepping in, you still want to stay true to your vision, as opposed to them trying to call the shots on some of it, even though, they've got skin in the game. But hey, you came with your vision. And if you can't fulfill your vision, then the cracks are going to be larger than the joins. So basically, you guys started as bootstrapped, and now you've got a few H&Is in the mix, and they seem to be working as a good catalyst to get you guys to your growth rate and where you want to be for the near and short
Yeah,
term.
it's worked well. And like, I'd be lying if I said, it was smooth sailing. Like, there are a variety of, you got to kind of listen to your customers. You got to listen to the market shifts. Um, and just be aware of what's going on around you. But, our early investors have been great, and, they've believed in what it is that we're doing. And we started getting more strategic. Early on, it was, people that just believed in, the founding team and believed in the problem you're solving. And then it was, okay, can we find some successful entrepreneurs that have exited companies that have been through this, and look for the experience that maybe, not everyone on the team has. And then finding some investors that actually operate in our kind of target market. So, those that have done very well and built out wealth management practices that are looking to invest money on the side, right? Looking for kind of examples of your kind of ICP that can,
Yes.
add value in different ways, because I don't believe all money's created equal.
Yes.
And so that's kind of how we've looked at it, and it's worked out really, really nicely. But again, it's about alignment, right? Is, you have to look at, what are people doing this for? Are they adding value differently? And do they believe in where it is that you're going? Understanding that, there are going to be times where it's 2 steps forward, 1 step back. But as long as the forward steps outnumber the backward steps, then you're doing okay.
Yeah. And I think you talked about ICP a little bit. I think that is key to getting your positioning right. And given that you're a B2B2C model, follower, I think, there's a lot to be said about how critical it is that your ICP alignment is solid. What does a typical day look like for you? I know you said you wear so many hats, but I think in the 4 years, things have changed, right? Things have grown. So your typical day, T minus 4 years versus today, like what's it like today?
I think the big difference between, kind of inception versus today is at inception, you almost anal retentive about everything,
Yep,
and
yep,
everything. You have your finger in everything. As you can probably tell, I'm a pretty passionate and type A personality. Empowering people and believing, that, they're connected to what it is that you're doing is a hard thing for some founders to let go of.
yes,
And so I think that's been the big shift. Is early on it was I knew everything, I was involved in everything, and I still am to a degree. I can't totally turn it off,
right.
but building trust and having, recruiting and keeping great people changes your day. Right. And so like right now I spend a lot of my time in kind of oversight on some major enterprise deals. I get brought in at the very beginning of a deal just to talk a little bit about the founding story, like how we've grown and where it is that we're going. And then I step back. I'm not, that involved in some of our larger enterprise deals as I was, previously. On the product, it's very much product vision connection, making sure that our head of product and I are in lockstep. He's the one doing all the interviews. He's the one talking to customers. I have visibility, but not really that, I wouldn't say a micromanage. And then, now we're getting into, a potentially large fundraising in 26. So that ends up being all of my time, right? Is I'm running that like it's a process, a very specific process and almost sales cycle that has work back plans and milestones. Like that ends up being my job and board management. So, it does still move, it does still shift on a day-to-day basis depending on the priority. But I would say that the micro kind of, in the weeds all the time, I actually miss that to a degree, because
Absolutely.
that building part is really fun. And now we're kind of in the scaling phase, which is a
Yeah.
different and very exciting opportunity. And I love what we're doing. But like, kind of building when there's no walls, and that's
Miss
that's
the
a really
action.
exciting part too.
It's the action that you're missing, and I hear you. Yeah, I think as we evolve as leaders, how well we delegate is directly proportional to the outcome, right? And sometimes it's hard from one type of individual to another. It's hard to let go of a process like, no, I need the period over here and the comma over here. Like how, this doesn't look right.
Well, I think a lot of it comes down to just, like I said, hiring and keeping great people. And we're so incredibly lucky. We have a ton of people that have been here from the very beginning or kind of in the early phases that have kind of grown with the company. And that creates a sense of ownership for them too. Right. And so it makes it so that like I don't really have to worry about those things. And I think directionally we're all very aligned. I massively over communicate with the team. I'm a very competitive individual. I played like university baseball. I still coach sports to a degree. So like coaching is very important to me. And I kind of embody that in how we build the company, in that every 2 weeks we have a meeting and with the whole company. And I literally explain things that like when the first early staff comes on, they're like, oh my God, no one ever tells me all of this information. Like normally I'm not privy to this. I said, guys, like we're still in startup phase. I said, well, we're 4 years in and we're this big and we have this many enterprise customers. I'm like, yep, we're still startup. And so because of that, you have to be aligned. You have to understand that what you're doing on a day-to-day basis impacts where we are and where we're going. Because if you don't, then it's like you're not connected from kind of that ownership mindset. And so because of that, I think you have to embody that and live it and really believe it. Otherwise, pulling back is much harder
It is.
because then you're really disconnected because you're worried they're disconnected and you blame them. Well, that's your fault as a founder if you didn't connect those dots for them in
Yeah.
advance.
Yeah. So it appears that you follow the Kaizen principle where there's always room for improvement. Yeah, I've heard this from a few founders, right? That hey, when folks think that hey, why are we still calling ourselves a startup and it's been a few years? So I'm like, just use the word that hey, we're following the principles of Kaizen, and Toyota does it even today. So like, why not us? So. Let's talk a little bit about industry trends. So, of course, SaaS market. I will say FinTech, right? What major industry shifts are you seeing given current situation?
Yeah, it's been, I think we sometimes ubiquitously kind of use like SaaS and FinTech, and I might even separate them to a degree in the sense that like I think some SaaS principles have started to die. Not that SaaS models are broken, and I don't believe that, but I do think that for a long time, SaaS got very focused on usage-based metrics. And, yes, ARR is important and expansion is important, but I think a lot of the kind of the B2C type metrics started bleeding into B2B, where it was like, daily active users, monthly active users as an indication of like stickiness and future. I think what you're starting to see now, especially with the continued and, fast moving pace of AI, you're starting to look at some of these, these B2B type, products, and these institutions are looking at it from the perspective of like, how are you just going to create efficiency in my workflows, right? Like net new applications that people are touching all the time. It's like, they kind of look at that and say, I've got enough. I got a capacity problem. So if you're going to make my capacity problem worse, I don't care how slick it is. I don't care how nice it looks.
Right.
That doesn't solve a problem for me. And so that's where I think that there's been a bit of a shift in market, is how some of these institutions are thinking about new tools. And they're saying, I have a core kind of tech stack that is crucial to my survival. If you can work within that and be additive or augment and create capacity for me, capacity is the big shift.
Yes.
Where it's less about like, is this neat? Does it look pretty? Like at the end of the day, like technology is incredible and the pace at which it's evolving is wonderful. But one core principle or tenet still remains. Technology has to do something. And if the something is that it like is net new and looks cooler than the thing before, that is a shelf life. It's like, is it actually additive to a workflow that is not leaving? Does it make the humans better at the human things? Those kind of, that for me is the future of this. And I think that where SaaS kind of got a little bit anchored in its theory in thinking like, well, let's just reinvent something that is like net new, that it's going to become core. So a lot of our institutions, like they live in their email and their Salesforce,
Right.
and maybe a financial planning software, and that's it. So it's like to give them something net new that doesn't interact or acknowledge that the ecosystem is already probably too busy for a human capacity problem that already exists, I think is a death knell for some companies. So that for me is a big market shift in how they're thinking and buying.
Yeah. I see a lot of chatter on Salesforce trying to, no pun intended, because Salesforce has a product called Chatter, but a lot of chat about how they're adding AI and they're trying to really promote the heck out of it. Most of your like small business type of customers, right? They have something like Intuit or other softwares that they use to do their day-to-day bookkeeping and whatnot. What is the adoption, I guess, or a quick, if you were to say, this is how we make it easier for them to use our offering while still retaining their QuickBooks setup or whatever it is there a way that you guys do it?
So the way it actually works is not originated from the business owner, it's originated from the institution.
Correct.
So what happens is this is where like I talk about embedding in an existing workflow. Like for instance, like if we work with an accounting firm, we become part of their year-end process. Every time a year-end gets produced, they're the one that produces the new year-end. They can either like, we can either integrate with their data lake and pull the data automatically, so we become a part or a segment of that process, and then it produces in platform the output of, this is what this business is worth, these are the tax opportunities that exist, I would talk to them about this, here's how they're performing relative to their peers. What it does is it injects insights and conversations into the human interaction that's about to happen, because they have to meet as part of their year end, because it's literally obligated. And so we become part of the workflow. And so we are very much like, Inter-Val actually stands for interactions that are valuable. That's what we curate. We curate valuable interactions between financial advisors and their business owners. So you think about a year end gets produced. Well, as part of your financial plan, you sit down with your financial planner every year. And It's, hey, here's all of my investments. Here's what I've done. Oh, and by the way, here are my business financials. Like, we should probably like figure out what that's worth too and put this into the financial plan. Well, right now that's all done manually. So we become part of that. Our system ingests, accountant prepared financial statements. It recategorizes the PDFs, and then it automates the production of this valuation, the underlying business health metrics. It tells the advisor, hey, this business owner should be doing this, this, and this, and you should be perhaps talking to them about an insurance product because it looks like, they might be under protected from an insurance standpoint. So what we're doing is we're actually really kind of feeding the conversations that need to occur so that the business owner is better protected. They're also aware of the value that they've been creating in their business all along, and the advisor knows how to help them and protect them.
Okay. Yeah, guys, I was trying to figure out, where that lands and how much of this, is, let's say, financial institution generated or utilized insights versus how much of this can be, an on-demand or something for the end business owner. So it looks like this sits more in that the institution space, augmenting the picture for them to provide better service to their business owners. Am I right in that assessment?
You're right around the origination, but I would take it a step further in that the business owner just ends up being the benefactor.
Absolutely.
Right? It's like they get it, and they actually, it's a double-sided platform. They both have logins to our platform. So the
Okay.
business owner gets to log in, they get to see how they're performing. They can even start like answering different questions. They can start like, they can build a timeline, they can set a goal for the future, and it actually tracks their progress. So it's very much double-sided, but it's originated by the institution because one, they typically have the data.
Got it.
They also like they benefit and they want to be they're the value add, right? They get to lead and say, hey, you're a customer of ours, this
Right.
is what you get.
Okay.
Whereas if we did it inverted, the only benefactor would be the business owner. Well, in this way,
Exactly.
I actually get to benefit both of them at scale.
Yes. No, this is brilliant positioning. Do the institutions ever, try to monetize this, or you've seen most of them just say that, you know what, to our $1 million and over ARR business owners, we will give this for free. How do you usually see them
So
licensing
early
it?
on, about at the very beginning, we had a couple of early partners try and monetize it, almost turn it into like a subscription type model. We actually told them not to because we said, guys, like wait till you see the data. Wait till you see the impact it has from an ROI. And back to my comment before that I believe software has to do something.
Sure.
It has to be ROI focused. And so like everything we do with our customers is proving, guys, well, I can tell you exactly how much money our customers are making off of this, and I'll prove it to you. And so because of that, we said, do you really want to charge like $100 a year? Like if you create, even if one customer doesn't want to pay that, and you've now created an impediment to adoption, you then don't get the visibility to the information.
Right.
And so we've actually been able to prove, like our largest wealth customer has proven that they've seen a 300% increase in net new dollars get invested with them by customers that were attached to the Inter-Val platform.
Wow.
So they saw that number and they said, well, of course we shouldn't charge for this, right? Like the ROI is so obvious. And why would we create an impediment for something that is probably never going to be a meaningful line item from a recuperation standpoint and pricing?
Sure. No, this is good insight, because for those that are thinking to monetize this kind of helps them see the big picture. Stop chasing the pennies. Like the 300% is huge. That talks to a lot. And so based on that, are you seeing a lot of case studies across your customers that are showing that you're on your consistent growth and increase?
We are, and it's actually it's part of the impetus for why we're going to do a significant fundraise next year, is that we were confident that the data was going to prove it out, but then working with our customers and their data science teams to be able to prove that this is actually occurring, the interactions that it's creating. So like we measure like net new interactions, like net new. So we actually built out a function in our platform that actually automates their meeting agenda for their next meeting with their client. They click a button and AI produces the meeting agenda based on the information that we have uncovered. It says, I would focus here, here, and here. These are the priorities, because we have a vested interest in that interaction being powerful and eventually monetizable. Right. So if we can now prove that, we then have a vested interest in making sure that that is a seamless process. So that's been the exciting part. Is we had a thesis. We wanted to make sure that our customers were voting with their wallets and buying the platform and putting it into play and seeing adoption. And then with that adoption, can you prove the ROI? Now we can. And now those are getting published. And now now this is why we view it very much as, the fundraise is the jet fuel, but we wanted to be able to prove it first, because I believe that if you raise a bunch of money and try and market your way to credibility, that is very dangerous.
Yeah.
But if you can market your way to credibility because you already have it in the form of data, that's very different.
Yeah. No, absolutely. I think you've kind of scratched the surface on my next question, which was talking about how this trend impacts your business or growth strategy. So from what you just said, it looks like this is helping you create your business case for funding, showing that year-on-year growth and the benefits of the interaction, and then the addition of AI in how it produces the interaction plan for the financial institution with their end customer. Is there anything you want to add about how this trend has impacted your business or your growth strategy overall?
Yeah, I think one learning for us and how it's kind of impacted, our growth strategy is we kind of went in with the initial thesis that, if you just gave advisors insightful information that they can easily action, that would be enough. And I think what we've learned is that the human capacity ends up still being a major constraint. And so it's funny, we actually got into this business with the whole concept of like helping the business owner, better way to do it through the institution. And part of the reason we wanted to help the business owners is, everyone talks about they call it the silver tsunami, or all the baby boomers looking to retire and get out of their businesses. And we said, well, these people need help in advance.
Yes.
And their financial institution or their wealth planner or their accountant are best equipped to help them in that journey. We wanted to be kind of that connective tissue. And the irony here is that, yes, the baby boomers are all retiring and leaving these businesses, and there's supposed to be trillions of dollars that's going to hit the market.
Mm-hmm.
Well, these financial services providers, again, wealth management, accounting, and banks, they're relationship managers. So when you think partner accounting firm, you think senior wealth advisor at a wealth firm, or, a banker account manager. They're also, a lot of them, the most experienced ones and the most knowledgeable ones, they're also baby boomers. So the problem these institutions have is they've got fewer people entering their industries, and there's never been more business owners in human history. So the chasm's actually getting wider, where we thought that, well, just surfacing these insightful conversations and just letting them do their job would be enough.
Yeah.
Well, that didn't solve for their own capacity problem, right? So now we have to go a step further. And that's where I think the shift has really happened. And that's where AI helps a lot is we're not going to do the entirety of their job. They will continue to be the human in the loop. They are the expert. But our job is to free them up to do the things that only the human can do, which is contextualizing, empathizing, selling. Those are things that AI can't do.
Right.
So how now do we infuse those conversations that there now will be more of, so that they are only doing more of the human delivery component? Because that will change the way ultimately financial services can hire. They won't have to hire a ton of expertise and knowledge because, to be honest, in about 10 years, it's not going to exist, right? So you're going to have younger people that will have entered. They just don't have the experience yet. And there's just not as many of them. So this is like, for me, that's kind of the shift in both market kind of sentiment, but then it's also a demographic shift that I think we have to be mindful of and the impact that it has.
Yeah. I just had a thought while you were saying that when financial institutions are getting this type of insight to analyze and create better planning and roadmaps for proposed to businesses, if it's a banking institution, right? They are able to see their visibility is limited to transactions that go on in the business day to day, right? Not much beyond it. But how do you create that bridge that gives them more than just the money in, money out state, day to day, and go into a deeper analytics, awareness, if you will, data awareness and transactional awareness? How do you bridge that gap?
Well, the way we actually implement it through financial institutions is very much through the wealth arm of the institution, in the sense that they're the ones that are best equipped from a aligned interest standpoint, where the vast majority of financial plans are all data based. Like they're based on factual data, except for one number, the value of their business. You ask most financial planners, say, what number's in there? They said, the number that the business owner told me to put in there.
Right.
No one ever validated it. No one ever went through the data. It just goes in there. Well, an SMB, statistically speaking, 85% of their future net worth is their business.
Okay.
So that means 15% of their financial plan is accurate, 85 is not, right? If we're not factoring in the continuous and ever-changing value of their business. And so when we go through a financial institution, that's ultimately how this gets positioned. It's how can I build the right financial plan for you if we both don't know the value of your largest asset. So let's start there. So it becomes part of that conversation where our system ingests their financial statements from their accountant that the business owner just drags and drops directly into our system, and our system automates the ingestion and then the production of the output. And then the bank is now made aware of, and so is the business owner. They both sit down and say, okay, we see you're sitting on a $7 million business. We see that you're performing ahead of your peers in these areas. You're doing really well here. Also, your balance sheet looks like you could probably handle a $2 million loan. You didn't ask for one, but maybe we should have a conversation about it.
Sure.
And it's like, what are your growth plans? Or like, how does this impact, your estate planning? Like it becomes part of the bigger picture. So you're infusing those conversations with more actionable data and making it very much an aligned interest. Like they care about your financial future. Of course they do. They want you to create a liquidity event one day, and then they want you to reinvest it with them. And they're not like, they shouldn't be ashamed of saying that.
Right. So it appears that there is some call to action from the business owner's perspective, right? To share certain amounts of data with the financial services company so that it can be turned into actionable insights and planning. Is that accurate assumption?
It is. And it's why it's so important that it's a double-sided platform, because the business owner has to get something in return as well.
Sure. And he's got to put something in to get in terms of sharing that, hey, this month we sold, this much more than last month, or we did, our services did better than our products, or what have you, right? Is this the type of data that, is usually collected from the business's side? Because the institution already has the transactions but doesn't know how they relate?
Yeah, so it's typically one of two ways, and usually the starting point is it can take up to 5 years of their last 5 years of statements, where
Sure.
they've all got them in one folder, they drag and drop, and it's done. Like it's
Yep.
done in under a minute.
Okay.
And so that's usually where they start to say, okay, let's produce a baseline. Let's figure out where are you today and how are you performing relative to your peers, where are you strong, where you're weak, and let's develop a plan.
Got it.
And then from there, they can actually upload as much information as they want, as frequently as they want along the way. They could even integrate their QuickBooks because we actually integrate with QuickBooks. So it's like
Nice.
they could actually do that, and it can do that on a month-to-month basis as well.
That's
So
good.
and so it really is kind of depending on frequency of usage and how they like to look at it. What's been fascinating is we've actually been able to monitor business owners' growth patterns. And we've been able to prove that business owners that actually monitor their underlying health and value, they grow 29% year over year in terms of enterprise value. It's like when I step on the scale. If I don't like the number, I run the next day, right? It creates behavior.
Right. Yeah.
And so like our belief has always been that like this shouldn't be a black box. Like their data has actually been giving them this answer all along. It's just been made very expensive for you to read it. Like to get a full blown valuation, it's like great. There are times where you need that, but no one should own the theory. Like you should always you should at least have a a general knowledge of, am I actually creating value or am I just making payroll?
And with this being the era where a lot of boomers are leaving the industry, retiring, trying to figure out what their next move is, I think we're at the right time to try to scale by helping them, right? Evaluate their current state of business, make sure that they're aware of potential so they can, when they're trying to sell it as an exit strategy, they're more empowered to provide the right insights to whoever next comes in. Because, what happens usually, the baby boomers are trying to find a buyer that can take it and run it, or one of the employees has an interest in taking it over, or then the last scenario is like, well, heck, I don't have any succession plan. I'm stuck with the estate planning. Again, tied to just what you said, like what do I do? So I feel like you've got
They
good.
deserve it. And I think, like I said, SMBs rely on it so much, right? When you get into your like 200, $500 million businesses, like at that point, they've created enough wealth, or the sale of that business is nice, but it's not what's going to make it possible to retire. You talk about SMBs, like people that are trying to create, $1 to $20 million businesses in terms of enterprise value. They're the ones that need it. They don't have a pension. And so for them, that liquidity event is exceptionally important. And I believe that institutions have an obligation, like wealth planners, accountants, banks have an obligation to take a proactive support kind of approach to helping business owners plan for this in a proactive way. Like it shouldn't be because you're 60 and tired that you suddenly
Right.
say, okay, I'm ready.
Yeah.
Right. Because the time where you probably should have done it could have been 7 years ago. You didn't know. Right. Like let's not let emotion drive it. Let's let the data drive it and have people kind of take control of that eventuality.
Yeah. Oh, great. So let's talk next about, what's, as a business, what's working well for you right now and what's been challenging?
I think what's working well is continuing to flex our startup muscle. I think there's a natural tendency for people to rush into saying, like you talked about earlier, I'm not a startup anymore, or kind of getting over bureaucracied, I suppose. And I think there's a natural tendency to do that. And I think that's one thing that we've done a really good job of, just kind of remaining centered and, understanding that, we shouldn't be in a rush to do anything, especially when like startup failure rates are so high. I do find it somewhat almost funny that like startup failure rates are high and yet we all copy each other. I'm just like, that doesn't make any sense, right? And so we've kind of tried to look at it systematically and say, well, whether you're a technology company or a SaaS company, FinTech, whatever, you got to solve real meaningful business problems. And you have to have leading indicators of future success upon which to make educated bets. And so I think we've done a really good job of staying with that. And then I think that maybe one of the hardest things, which I still am challenged with, is remote work. We're fully remote. We've got people all over North America. I have a few kind of hiring rules and the number one rule is that we will only hire energy givers, not energy takers.
Yep.
And so basically that doesn't mean you need to be an extrovert like me. I know our company couldn't handle too many of me, but what it means is that you have to go into every interaction or leave an interaction with somebody and say, I feel better after that interaction. I feel like they breathed oxygen into that room.
Yep.
And it has now stoked the fire that I think we can all kind of, go about our way. And you can believe that can be part of your company culture. That can be, your core beliefs, but it's sometimes it is hard to kind of keep in practice. And there are days where I long for in-person work. Can be inefficient. at times. And so that's kind of, that's why we went the route we did. But you have to remain very committed, especially as you scale and your employee base grows, that you kind of understand what makes you great. Like, what is your secret sauce and how are you going to continue to curate that in a remote environment? And that's challenging.
For sure. Any other challenges that are plaguing you, like for the immediate scaling or growth of your company?
Yeah, I'd say that when you're scaling and specifically around fundraising, fundraising is a bit of a learned behavior. And, I've been a founder before, but it was of a services company. I worked myself and my co-founder, actually, prior to this company, we were the founders of an M&A firm. And so that was different. Right. It was more traditional business. And then as we got into this and we applied some of our learnings and expertise from that into this business, and you can see kind of where the overlap came from. Fundraising was different. Right. It was different for me. It was a new thing. I had to reach out to a number of, other founders that had been through it, learn kind of the process, what works, what doesn't. But I've kind of been through we've only been around for 4.5 years, but we were born in COVID. Market was super frothy. People were throwing money at things that were just ideas, didn't make a whole lot of sense. And then it shifted, and then it became more about okay, capital efficiency became cool. Whereas before, I got told, hey, you're not growing fast enough. It's like, wait a minute, I could be burning, but that doesn't make any sense. And so and then the market shifts. And so I think that's always a challenge, is understanding what's going on in the market. You're never going to time it, so don't even try, but just look at capital as kind of the fuel to make you go faster, but make sure that you can operate on your own too. And that's always a bit of a challenge, because you're kind of beholden to market factors. So you got to be aware of what's going on, but getting down the rabbit hole on Discord or Reddit or YouTube can be a very, very dangerous path to go down as well. So kind of stick to your lore, or stick to what works for you and your company. But that's hard. It's been a challenge and will continue to be.
Yeah. No, I've said this to a lot of folks, right? Anything born in adversity is more resilient than something that's born at an up time or a happy time. So I feel like you guys are super resilient, and your growth, from a startup onto year 4 is definitely commendable. As the leader of the company, what metrics are you most focused on improving?
Very good question. We focus a lot on the kind of core to us. We focus a lot on, yes, usage metrics, which are great, but it's more about the quality of the usage, right? And so we look at some of our enterprise accounts, and we have a lot of multi-year deals where we very much look at it as a crawl, walk, run, and scaled, because we understand that from a change management standpoint, the likelihood of them getting every one of their advisors and every one of their business owners on in year 1 is not high. And so we look at it as, okay, let's scale this. We even scale the price and say, look, guys, you can use it as much as you want. Right. So that's kind of the inverted kind of SaaS model for me. Was always why are we trying to make it worse for people to use it more? If your platform is legitimately good and is creating ROI, you should want people to use it.
Yeah.
And so we've kind of priced it that way as well. And so we're monitoring usage, but it's more so about the quality of the interactions that occur. Right. And so we talked about ROI based. And so we're really focusing a lot there. And then for us, kind of being small and mighty, revenue per employee is something that we're weirdly focused on, because I want to be able to prove, and it's at a number that we're very, very proud of right now. And it's because, we're not massive, but with the customers we have are, and, we've tripled in revenue in, the last 14 months, right? So it's we're on a really cool trajectory, but we want to show that we can do it in a capital efficient way, so that when we do raise capital, it's now about replication. It's not about, hey guys, let's just go try some stuff and see what works because we have $10 million in the bank, right? That seems stupid and dangerous. And so for us, we said, let's show from a revenue per employee standpoint that our customers are voting with their wallet. And the reason they're doing it is because the ROI we're creating for them. And if we can do that with a team that is lean and mean, that is replicable going forward.
No, very true. 3x in 14 months. That's pretty crazy.
Yeah, it's a lot of it was expansion of our existing customers, right? Is that when you're dealing with large customers, you prove it, and then you say, hey guys, the business case is too obvious to ignore. And so we've had a number of our customers say, you're right. It's the only thing missing here is us using more of it. And we are committing to doing that. And here's the scale, and the ROI for them is great and through the roof. So it kind of creates a scenario where I'm a huge believer that if someone has to lose in order for somebody else to win, your solution's broken. So it's if you can figure out a way that you're winning and they're winning and you can prove it, people are happy to pay for things that create value.
Yeah, for sure. You mentioned ICP, so I'll have a question with regards to that. What is your dream ICP, or do you have one?
So we're probably inverted in the sense that we've done exceptionally well upmarket in the enterprise space. Like we have logos that you would all recognize, like some of the big banks across North America, some massive wealth firms, some of the biggest accounting firms in the world, right? Like we've some customers that, quite frankly, as a early stage company, we're lucky to have. We've done very well there, and the expansion in those now becomes really exciting because we found additional use cases. We found new products we've spun up, and like it's become very, very interesting. We're like we started off purely in the business owner space, obviously identifying the financial statements as kind of this key to unlocking these interactions. Well, one of our wealth firms said we also interact with a ton of personal tax documents, and we never know what to do with them. Could you apply your AI? Could you help us make sense of that? Could you augment those advisor discussions? And so we did. And we built that because we believed it to be representative of the market at large, not just a one-off customization. So we built that and just launched that product. So for us, the dream ICP is very much there in that these institutions do have a lot of manual processes. They're sitting on a lot of data. They acknowledge it. And it's not that they don't want to do something, it's that they don't have the infrastructure to do something with it. So we become part of, their evolution in how to turn this data into meaningful action that benefits both them and the individuals that they serve. So we've done very well up there. We're now working on how to deconstruct our product into more of the mid-market, lower end of the market where we can create a more consistent kind of revenue flow. But we're not going to look a gift horse in the mouth. We know where we're good and we know where we add a lot of value. And over time, that gives us the data to prove impact, to then take down market, to create a bit of a go-to-market in the mid to lower end of the market. So that's kind of how we're looking at it, is let the data sell for us later. And we're getting a lot of great data from our enterprise customers.
If we're to compare your customer base, US versus Canada, are you seeing a lot more, of course, the US prides themselves on being more risk-taking and more, they vote heavily with their wallet. Are you seeing a lot of growth on this side of the border, or is it pretty balanced across both markets?
So it's funny, in our evolution, we made a strategic decision, and I'm glad that we did, that most Canadian companies are always taught, it's like, just get into the US market. It's like 30 times the size. And and obviously, like from a size profile, it is.
Yeah.
But like, we kind of looked at it and said, well, if you're not going to be massively capitalized, not venture backed, there's only the one problem with the US market is that, yes, it's massive, but like everyone knows it's massive. So the noise in the market is so much greater. And so you have to market your way through that noise to credibility. And what we said is, well, if we're not venture backed, then one thing that we can do, one thing that will break through the noise when we enter the US market, was the successes of recognizable logos in Canada that US companies either know or also compete with because they're also in the US. Take that data as your wedge in. And so we focused there. So we built up in Canada quickly. And then we entered the US market about a year and a half ago with very much, here are our customers.
Mm-hmm.
This is what we're doing for them. This is the impact we're having, as a way to cut through the noise. And it's worked. And so like our revenue is about 75-25 Canada, US right now, but our pipeline is inverted. Our pipeline is like 80% US, 20% Canada. Right. So, but we wanted to do it in the way that like you wouldn't just have to spend your way to credibility, because that is a very, very dangerous game.
Absolutely.
We waited until we had the data to be credible to then enter.
The pipeline, there's such a big market, so much more noise, and I feel like you're trending in the right direction, which brings me to the next question. What are we at? 51. Okay. Where would you like to be in the next 6 to 12 months from now?
For me, it's funny. If you asked me that question probably any time in the last 4.5 years, I'm not sure I would have given a good answer, but for the first time ever, the next 6 to 12 months are probably the most clear to me. I now have the confidence in, again, the foundation that we've built that can bear the weight of money. And so, for us to build a truly replicable go-to-market engine. Now, again, even go-to-market and like SaaS pipeline building is changing, and that's like probably another podcast for another day. But, so how you do it might be different, but we've never really built out a true go-to-market engine. It's been a lot of, word of mouth, customers making referrals for us. Yeah, we get some inbounds, but we don't spend massively on marketing. It's been kind of systematic in how we've built this up. But we have the data, we have the customers, we have the success stories that, like, for me to now commit investment into that is an exciting time. And so to be able to show that, we've kind of done this pseudo organically to date, but now I believe that there is just fuel missing. And that's a pretty exciting thing, exciting time, and kind of it's a new stage of our journey for sure. And it comes with all kinds of potholes. Like, it doesn't mean that just because you were good when you're scrappy doesn't mean you're automatically good when, you build a larger engine. So you got to kind of find that line. But for me, that's the next 6 to 12 is It'll probably be in the growth equity space would be my guess, where our funding comes from. And it kind of produces a unique opportunity for us to really hit fast forward. But I'm not going to stray from, I think you can still grow pretty dramatically and not like go straight up spray and pray and,
Right, right.
like no one cares if you die. Like I don't really ascribe to that theory. So for us, I think that's a pretty exciting time, is to, get some capital on the balance sheet, really begin to deploy it in a thoughtful and intentional way and build this out in a replicable kind of model. That's, for me, it's an exciting 6 to 12 months. And now it's my job to deliver on it.
So you guys are doing a lot of your, expansion through referrals and warm leads and one relationship bank, let's say one financial leader to another type of like, hey, I saw this and you should try it kind of channel.
Yeah, like we've got executive champions from some of our enterprise customers that have taken prospect calls for us, where they'll say, "Hey, do you mind if I have this prospect call you?" Like they're competitive to you, but like they want to hear more about your experience. Or, hey, this person's in the States, but like they know that you're large in Canada. Would you be willing to take their phone call? And we've got customers that take prospect phone calls for us. And they say, like, look, I realize you're probably going to sell into them anyways. And their belief is that if we get more revenue and we get more customers paying us, and our system gets better, our product gets better, they said they're just betting on their ability to mobilize. They said, we've been a customer of yours for 2 years. And if other people start paying you, we just think we're going to be better at it. And so it's like, great, you invest more in the product. There's more for us to give because we think we can mobilize better than our competitors. And I think that's a great way to have your customers look at it. And then also like, kind of help you continue to grow and not look at it as like protectionist.
Yeah. If you're creating evangelists out of customers, you're already winning that, a significantly uphill battle. So kudos to you on that. I think we are at a final question. And this is a semi-fun one. So if you had a magic wand to fix one thing in your business that's holding you back or slowing you down, what would that be?
Very good question. I would honestly say that, one thing that I think it doesn't slow us down anymore, but if I could go back in time, I was probably guilty of almost overlearning. And what I mean by that is not learning from our customers, but I think that a lot of startups, I made the joke earlier that I don't understand why we all copy each other when the failure rates are so high. But I think if the availability of information can actually be a problem to early stage founders, because you end up, you read everything that's going on. And I'm a voracious learner. I wanted to learn but then as a result, you almost create like analysis paralysis.
Noise.
Yeah. And at the end of the day, and I had a mentor tell me this once. He said, your instincts are good. And he's like, he invested in our company as like a private high net worth. He said, your instincts are good and I'm betting on you. And do I think you're going to be right all the time? Nope. But I think you're probably going to be right like 80% of the time. So he's like, if you're going to like just make a decision, make it fast. And who cares what the frameworks say? Who cares what certain authors have said or what worked for them? Your business, trust your instincts, because at the end of the day, you're the one that's got to live with it. And I think that for me, if I could go back in time and, relearn how to build a startup, it'd be that a lot of the people that are teaching, they might have done it or might have done it well once, but like that doesn't mean they're infallible. And it's almost like religions where it's like there's so many and everyone has certain things that they believe in, and that's great. Sure. But that doesn't mean you have to convert every time you read something new, right? Is that you can learn, you can understand, distill, but then what does it mean to you and what does it mean to your organization? I think a lot of startups and founders in particular run into that problem, and it's something that I wish I could go back and say, you know what, you're going to be right more than you're wrong, so just make quick decisions and go.
Yeah, no, that's brilliant. I really appreciate you sharing all your insights today. Tsunami, it's been a pleasure having you on, and I think I have learned a lot, and I'm sure when we publish this, we're going to have the same feedback. Any closing messages before we end the recording?
No, I appreciate you having me. It's, oftentimes you're doing, podcasts or interviews that are talking about, your business and where you're going or the industries that you serve. I think that, founding a company and building startups is a lonely exercise sometimes. You want to surround yourself with good people and kind of build it out with them. So to be able to tell kind of our story and things that I've learned, if it helps one person and they say, hey, they don't want that, that sounds like me, or it's okay to not know everything, and then that's helpful. So no, I appreciate you having me, and it's great to tell the story.
Pleasure's mine, Trevor. Thank you very much for being here.